Welcome back. Today on KIP TV we're re-examining the US banking crisis and its potential effects on the US economy. Now, let's have a look at today's US banking system. The United States is currently in the midst of a banking crisis. This crisis is caused by a number of factors, including the Federal Reserve's aggressive stance on interest rate increases, which has led to losses in the banking industry's securities portfolio. The run on Silicon Valley Bank in March 2023, which has led to a loss of confidence in the banking system. The de-dollarization of the global economy, which is leading to billions of dollars of capital returning to the United States. Taxpayer-funded bank bailouts, and depositor-funded bail-ins. In the past, the US government has bailed out banks that were on the verge of collapse. This was done in an effort to prevent a system-wide banking meltdown. However, taxpayer-funded bank bailouts are not sustainable in the long run. They create moral hazards, which encourage banks to take on excessive risk. They also lead to inflation, as the Federal Reserve prints money to finance the bailouts. Conversely, a bank bail-in is a process where depositor money becomes the funding vehicle for that institution, and the depositors become an unsecured general creditor of a bank that's on the verge of collapse. This means that depositors may not get all of their money back. Bail-ins are a more market-based solution to bank failures than taxpayer-funded bailouts. However, they can still lead to financial instability, as depositors may lose confidence in the banking system. In effect, the depositor becomes an unsecured general creditor, because when you deposit money in a bank, you're essentially giving them an unsecured loan. If the bank faces issues, you're not the first in line to get your money back. You're an unsecured general creditor. Meaning after secured creditors, preferential creditors and FDIC payments, bank depositors receive whatever's left. De-dollarization and its effects. The de-dollarization of the global economy is a trend where countries are moving away from using the US dollar as their reserve currency. This is being driven by a number of factors, including the US government's large budget deficits, the Federal Reserve's quantitative easing program, and the perception that the US dollar is no longer a safe haven currency. As more countries move away from the US dollar, billions of dollars of capital will return to the United States. This will lead to an increase in the money supply, which will cause inflation. In addition, the Federal Reserve will be forced to raise interest rates in an effort to combat inflation. This will lead to higher borrowing costs for businesses and consumers, which will slow economic growth. And when those dollars return to the US, the influx of excess currency will lead to the following events: rapidly rising prices of goods and services. Currency debasement, your money's purchasing power drops. Rising interest rates, borrowing becomes expensive, impacting homes, businesses, and your personal loans. Hyperinflation, prices skyrocket at an alarming rate. The social repercussions. And how it will lead to political, civil and social unrest. The current banking crisis has the potential to lead to political, civil and social unrest. This is because the crisis is causing unprecedented economic hardship for many Americans. As people lose their jobs and their homes, they will become more likely to protest and riot. In addition, the crisis will lead to a loss of confidence in the government, which could lead to political instability. Statistical data. As of March 31, 2023, the FDIC has assets of $128 billion and liabilities of $23.7 trillion. This means that the FDIC does not have enough assets to cover its depositors' liabilities. The Federal Reserve has raised interest rates 11 times in a row since March 2022, raising the Fed funds rate range to between 5.25 and 5.5%. The banking industry had some $620 billion in unrealized losses in the securities portfolio at the end of 2022. According to data published by the Federal Reserve, smaller U.S. banks lost nearly $200 billion in deposits in the week ending March 15, 2023. And the sector may experience more consolidation within the coming months. The US dollar has lost 10% of its value against the euro in the past year. And finally, since 1933, the US dollar has lost 96% of its domestic purchasing power. The Federal Deposit Insurance Corporation, FDIC, insures deposits in US banks up to $250,000 per depositor, per account type. This means that if a bank fails, depositors are guaranteed to get their money back, up to $250,000 per account. The FDIC is funded by premiums that member banks pay. These premiums are based on the size and riskiness of the bank. The FDIC also receives interest income from its investments. The FDIC is a vital safety net for the U.S. banking system. It protects depositors from losing their money when a bank fails. This helps to maintain public confidence in the banking system, which is essential for economic stability. Understanding the how of our financial system isn't just for economists. It's for every citizen to know, prepare, and act. If you found this video insightful, remember that knowledge is power, so like, share, and subscribe to empower others. Thank you for watching.